Good afternoon. Shares in the Asian region rose with stocks in Hong Kong leading gains regionally. The Hang Seng Index in Hong Kong soared about 2% and mainland Chinese stocks rose on the day. In Japan, the Nikkei closed higher above 1%. Meanwhile, investors await the release of U.S. consumer inflation data expected for tomorrow for clues on how the Federal Reserve could react to the rising price pressures. But talking about how all of this could impact some of our local markets as well, we are joined by Chantal Marks, who's from F&B Wealth and Investment. Chantal, thank you so much for your time. I mean, given the fact that right now it seems as though there's a mixed performance when it comes to our global peers, everybody looking out for that inflation data, how's our local markets reacting to all of this anticipation?
So our local market actually looks quite solid today. We are trading in record territory, really driven by a really nice rebound in Naspers and Prosus as well as Richemont. All three of those stocks are very much heavyweights on the JSE. Naspers and Prosus being spurred on by what was a positive day for most Chinese stocks overnight relative to the day before, where we actually saw quite a bit of pressure coming through because of a new China list that was released by US authorities. So a lot happening at the moment, but I think the general sentiment, particularly around equities at the moment, seems to be positive. You would have seen that in US markets overnight as well.
How's our rand faring? I mean, given the fact that tomorrow we've got manufacturing and mining figures that are going to come out, we also have the State of the Nation address that we're looking forward to, and then you add in that CPI figure that everyone's anticipating will probably be around 7.3%.
And that's where I think the focus for the rand is right now. So we've got like a relative calm in global markets generally at the moment, and the rand is reflecting that. So we are seeing the rand strengthening, trading towards the bottom of its trading range, and really not moving that much in response to what I think is kind of local factors at the moment. The rand not really saying anything about the State of the Nation address. And really, if you look around the media, no one's really saying anything around the State of the Nation address. So perhaps there will be some interesting announcements there, perhaps around lockdown restrictions or the state of disaster possibly being lifted. But the sense is that there won't be anything game-changing coming out of that specific address.
If you had to take a bird's eye view, what would you say is the biggest influence weighing on market sentiment right now?
It is definitely inflation and the interest rate outlook, particularly in the US, where I think we have the biggest issue with inflation currently. Because inflation not only is a problem because people's actual money in their pockets become worth less and less and less, it's become a political hot potato, which has actually resulted in, I think, the major risk to global markets at the moment being an overly hawkish Fed. So what I mean by that is that the Fed reacts to political pressure to deal with inflation. They increase interest rates by too much, and that has a knock-on impact on markets as well as interest rates globally.
So earlier on, Sands, we had SABC releasing their Q1 results and commenting that the quarter exceeded expectations. And when you look at that share price up about 12%, what did you make of some of the information that they gave for this quarter?
Yeah, at one point the share was up almost 20%, and then I think there was a little bit of profit taking coming through. But certainly the market reaction reflecting what is a much better result from SABC relative to what we saw in that quarter, that same corresponding quarter in the previous financial year. And in terms of what the company guided for, also surprising us to the upside. So the company was actually quite bleak. Management was quite bleak following the KZN unrest. They were talking about supply chain issues and a whole host of other problems. But pricing seems to have been quite supportive, and the volume losses that we expected weren't nearly as severe as they guided for.
Right. What sectors are you more cautious about, especially as most central banks move towards normalization and policy tightening?
So this is quite an interesting one, and it depends on where the valuations look a little bit stretched. So from a central bank tightening perspective, we would expect companies with very high growth expectations going forward, having it having the largest impact on those companies rather. So specifically, that would be the technology space. Then, of course, if interest rates increase, it's generally bad for consumers. So consumer-facing stocks would also generally come under pressure. But I don't think that those stocks are nearly as expensive as some of those technology stocks have been. And now even the technology stocks aren't even that expensive anymore. I think the easier answer is, what am I not worried about? And in a rising interest rate environment, you are generally not that worried about financial stocks. So banks and insurance companies generally get quite good support from rising interest rates for a variety of reasons.
Chantal, let's leave it there. Thank you so much for your time. That is Chantal Marks from F&B Wealth and Investment.